Hi traders, today we're discussing government bond yields and interest rates. You might have heard these terms tossed around a lot, especially in the news about the economy. But what exactly is the relationship? First up, let's talk about monetary policy. Central banks like the Federal Reserve or the European Central Bank set short-term interest rates to guide economic activity and control inflation. These rates are also known as the overnight rates, and they have a direct impact on government bond yields. When the central bank raises its policy rate, short-term government bond yields, such as the US 2-year bond yields, typically increase as well. Conversely, when the rates are lowered, yields drop. This is because these short-term bonds are highly sensitive to central banks' immediate actions. Now, let's shift our focus to long-term government bonds, like the US 10-year or the 30-year bond yields. Unlike their short-term counterparts, the yields on these bonds are influenced more by what investors expect in the future. This includes projections for future interest rates, inflation, and overall economic growth. For example, the risk of changing interest rates. Inflation expectations play a huge role in determining bond yields. If investors expect higher inflation, they will require higher yields, so the return on the bond to protect their returns from being eroded by prices rising. On the other hand, if inflation is expected to be low or stable, yields tend to remain lower. A good example of this was when inflation rose. Expectations of rate hikes also rose, seeing the bond yields move higher. We can see on this chart the inflation rate in the US moved higher in 2020 to 2022, and so did the US 10-year bond yields as they anticipated rate hikes by the FOMC. This could also be seen on the yield curve. Typically, a yield curve slopes upwards, meaning long-term yields are higher than short-term ones. This reflects the higher risks associated with long-term investments. But sometimes the yield curve can invert, with short-term yields higher than long-term ones. An inverted yield curve often signals that investors expect lower rates in the future, potentially indicating an economic downturn. This can be seen with the relationship between the US 2-year bond yield and US 10-year bond yields. Essentially, the US bond yields are falling, so the market sees the FOMC cutting interest rates in the US. Thanks for watching. If you found this video helpful, make sure you like, subscribe, and hit the bell icon for more insights. See you next time.